Welcome to This Explainer, made by Forge College. Today, we're taking the pure technical concepts we've learned and translating them into cold, hard economic reality. We're looking at block rewards, incentives, and halving events. Let's get right into it. So, in our previous explainer on mining mechanics, we looked at the sheer intense computational gymnastics required to mine. And honestly, it brings up a multi-million-dollar question. Why on earth would any rational person, let alone massive corporations, spend millions on specialized hardware and astronomical electric bills just to have computers guess random numbers all day long? I mean, it sounds completely absurd, right? Well, it's not a charity. It is a fierce, global competition driven by a highly lucrative paycheck that's waiting right at the finish line of every single block. And that finish line reward? It's primarily driven by what we call the block subsidy. By definition, this is newly issued, freshly minted Bitcoin. It's created by the network's consensus rules and assigned directly to a block's first transaction, the Coinbase transaction. To put that in perspective, across the entire global network, roughly 144 blocks are successfully mined every single day. That means 144 times a day, some miner somewhere hits the jackpot. It's the absolute monetary lifeblood, paying for all that expensive hardware and power.
To really wrap our heads around this, I want you to picture the network as a giant, precisely timed faucet. Every 10 minutes, this network faucet opens up and pours a fixed amount of brand new Bitcoin into the ecosystem. The miners are essentially standing underneath it with buckets. The size of their bucket, meaning the amount of drops they can capture, is entirely determined by their hash power. Basically, the more computing muscle they bring to the fight, the more of that 10-minute flow they get to keep.
But here's where the plot really thickens, and it all revolves around one specific number, 210,000. You see, the Bitcoin protocol is completely deterministic. It doesn't care about Federal Reserves, it doesn't care about inflation, and it certainly doesn't care about a miner's massive electric bill. The protocol dictates that exactly every 210,000 blocks, which translates to roughly every 4 years in human time, the flow of our network faucet must be brutally and unforgivingly cut in half. There are no board meetings, no debates. It's just a mathematical rule executed by every single node. And looking at the history brilliantly illustrates this reality. Back in the Genesis period in 2009, the faucet was pouring a massive 50 Bitcoin per block. Then, 210,000 blocks later, it dropped to 25, then down to 12.5, then 6.25, and so on. This deterministic, geometric decay creates a predictable, disinflationary path that ultimately caps the total supply at exactly 21 million Bitcoin. There are no exceptions, no bailouts. It is just pure math enforcing absolute digital scarcity. Let's make this a bit more tangible. Imagine you're running a massive mining facility. You've got the deafening fan noise, the racks of servers, the whole shebang. And let's say you control exactly 1% of the entire network's hash power. Since roughly 144 blocks are mined daily, your 1% share means you can expect to find about 1.44 blocks every 24 hours. That's your piece of the pie. Your entire business model, your loan repayments, your power contracts, they are all completely modeled around securing those 1.44 blocks. So the absolutely crucial question becomes, what happens to your revenue literally overnight when a halving hits? Think about it. Pre-halving, let's say at 12.5 Bitcoin per block, the total daily issuance is 1,800 Bitcoin. Your 1% nets you 18 Bitcoin a day. Life is good. But the split second we cross that 210,000 block threshold, network issuance drops to 900. Without you changing a single machine, your revenue immediately crashes to just 9 Bitcoin a day. Sure, transaction fees might offer a tiny little cushion, but make no mistake, it is a sudden, violent 50% revenue shock. And this brings us to the absolute most stressed out protagonist in our entire ecosystem, the marginal miner. In any competitive market, this is the least efficient operation that is barely keeping the lights on. Their operating costs are hovering right at their revenue line. When that halving hits, they are suddenly completely underwater. And by the way, understanding how to model and survive these exact real-world market pressures is a core focus of the deep dive explainers we produce at Forge College. So what exactly goes onto a panic-induced survival checklist when your revenue is slashed by 50%, but your utility company still demands full payment? Well, step 1, improve efficiency by buying newer, faster machines. Step 2, cut costs. You might literally have to pack up your entire warehouse and move to Texas or Iceland for cheaper power. Step 3, pool your resources to smooth out that volatile income. Or if all else fails, step 4, accept defeat, pull the plug, and exit the game entirely. But that begs a massive system-level question. What actually happens to the network when mining becomes unprofitable for these marginal players, and they pull the plug en masse. If thousands of miners just give up and shut their machines off, does the network grind to a halt? Does block production just stop? It's a pretty terrifying thought for a decentralized system. But the protocol has a really brilliant built-in defense mechanism. As fleet hash power drops because all those marginal miners are fleeing, the network notices that blocks are taking longer than 10 minutes to find. So, roughly every 2 weeks, the network automatically adjusts its own difficulty downward. It literally makes the cryptographic puzzle easier to solve. With a lower difficulty, the miners who actually survive the halving now have an easier time finding blocks, which eventually restores their profitability. It's an incredibly elegant yet ruthless self-balancing market. Now, looking decades into the future, as this geometric decay continues, the dynamic shifts entirely. Right now, the block subsidy is the massive slice of the revenue pie, and user transaction fees are just a small sliver. But as the subsidy faucet shrinks to a mere trickle over the coming epochs, the network's massive security budget, the very thing keeping everyone's Bitcoin safe, has to transition. It must shift from an inflation-funded model to a purely market-driven, user fee-funded model. Which leaves us with this final, somewhat provocative thought. Will your cost base survive the next time the faucet turns down? Because the protocol waits for no one, and the next 210,000 block interval is always ticking closer. Understanding this dynamic sets us up perfectly for our next explainer, where we're going to explore the intense economics of hardware infrastructure. This explainer was made by Forge College. Be sure to visit forge.college to master more Web3 topics. Until next time, keep learning and keep building.